We all love a good data point, a good macroeconomic figure, or at least my fellow market commentators and I do, as rabbiting on about them keeps us in gainful employment. However, the thing that many talking heads and investors forget is to keep these figures and news releases in their proper context. Yes, a headline figure can make the markets jiggle about, but if you're a long-term portfolio builder, only too well aware that expenses and excitement are your enemy, as Warren Buffett put it, they need to be viewed in a long-term context and not in isolation. Now, two great examples coming up are the first quarter GDP numbers due out of the UK and the US on Tuesday the 28th and Wednesday the 29th respectively. Hello, I'm Russ Mould and this is Breaking the Mould, our regular look at the financial markets. Now, these GDP numbers will inevitably draw comment, and without wishing to put you off watching the next 2 minutes of me sitting here, my message is don't get carried away, especially when it comes to looking at what those headline numbers mean for your portfolios, and there are two reasons for this. First, GDP figures are backward-looking, whereas financial markets are forward-looking discounting mechanisms. Traders are already looking forward to the second quarter and beyond. Investors will be thinking about next year or frankly the next decade because it's long-term cash flows that ultimately dictate company valuations and therefore share prices. Second, economic growth is just one factor in determining short-term sentiment and long-term market trends. Investors also need to be aware of interest rate and bond market movements, growth, or the lack of it, in corporate profits and cash flows, and valuation. Markets tend to soar when rates are going down, profits up and stocks are cheap relative to their history. And they tend to crumble when rates are going up, profit growth is waning or negative, and markets trade on above trend multiples. Just think about it for a second. A rise or fall in GDP of 4 to 5% is a big deal, but in share price or stock market index terms it's really neither here nor there. This is because GDP growth sets the base, but on top of that you get the operational and financial gearing, which means corporate earnings rise or fall a lot faster than GDP. And then you get market sentiment, greed and fear, which means stock market multiples go up and down. That trio, GDP growth times operational gearing times valuation multiplier, is why stock markets swing around like they do. Just look at the chart behind me. It shows UK GDP growth as the bar, FTSE 100 corporate profits growth, and then the change in the FTSE 100 index as the lines back to 2006. So yes, pay attention to GDP numbers, they're just one starting point though. Now, as for the figures themselves, on the UK on the 28th, consensus looks to be for a 0.6 to 0.7% quarter-on-quarter increase. The highlighted bar at the end here is the consensus for Q1. On a year-on-year basis, that translates into a growth rate of around 2.7%. Again, the highlighted bar at the end is the consensus for the first quarter. Now, the American figure may actually be the most interesting one, not least because estimates have come rattling down in the past few weeks. The Atlanta Federal Reserve, with its GDP Now service, has cut its estimate from 2.5% growth to 0.2% for the first quarter in the last 6 weeks. Taking that as the consensus, the quarter-on-quarter progress in US GDP looks as follows, and the Atlanta Fed's estimate is again highlighted at the end. If the US number is weak, it'll be intriguing to see the market's reaction. It may be disappointed and mark stocks down, fearing weak corporate profits growth. Equally, it could, perversely, mark them higher, as a soft figure might mean the Federal Reserve delays the first increase in interest rates, keeping money cheaper for longer and potentially encouraging investors to seek riskier asset classes like equities for premium returns to cash. So, let's see what happens on the 28th and 29th, and thank you for watching. See you next time.